Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is August 9th edition of Market Outlook. Don't forget to sign up for this by going to our website at www.marketgauge.com and receive this free every week. Okay, so market definitely ran into some trouble this week. Corrected the last week, relatively decent sized rally. We were concerned about a couple of things. Certainly, the market internals and the narrowing breadth was of concern. So let's this week we're going to do something a little bit different. We're going to take a look at the Market Gauge website because there's some good resources and some excellent information on it. And you can see that by, if you go to resources, there's something called Little Big View, which is where we are. And that includes Mish's daily commentary, as well as some excellent tables. So first thing to look at is just overall, you can see the S&P basically year to date flat, over the last 3 months actually down. So really a relatively meager performance. That sort of relates overall to the economic numbers that are coming out. We're getting modest growth, but a lot of that has been tempered by the very weak energy sector. And so earnings are okay, but not great. And overall, longer term, that's what drives valuations of the market. And with the market running rich and relatively meager growth, you're getting this type of sideways flat action. So just looking here, you can see that out of our 11 sectors, over the last, or 6 months or year to date, at least half of them are down. And actually, the largest movements are on the downside in energy. And so you have a couple of leaders. You got some healthcare, the financials are doing well, and some of the consumer discretionary stocks as well. But as you can see, this week, since these are highlighted, we went into bearish modes in semiconductors and back into bearish again in transportation. Now, another thing that is quite useful is just looking at volume patterns. And on the market overview page, you can see that the accumulation distribution days, which tells you all about institutional buying or selling, shows that we're basically getting a lot more distribution days over the last several weeks than accumulation days. And in fact, what is also interesting to point out is the diamonds, right? The Dow actually had an increase in volume on a Friday during the summer, even though the price change was down. That's a distribution day. Now, interestingly enough, relatively weak volume in the S&P and the NASDAQ, but strong volume in the Dow, and that was pretty weak performance. And let's look at the chart right now in the Dow. Okay, so here we have it. The Dow forming a very nice downward channel, and a couple things to point out. Number one, look at this 50-day diving and attacking this rising 200-day. So clearly trend strength is weakening. We're in what we call with the 50 over the 200, which is that green line. When that happens and we trade under it in price, under the 200, that is a distribution mode. So interesting, getting a lot of distribution days consistent with what Little Big View is saying, as well as the market is definitely trading on the weak side. And this is clearly the weakest close that we've had in the Dow going back to February of this year. So that's noteworthy as well. Also notice, look how many red days in a row you had on the candles. So you've had basically 7 consecutive down days. That has not happened in quite some time. Also significant. So definite downtrend forming. You have some reasonable support around the 171 to 170 level, right? This area here should materialize as some level of support. Now, what is interesting, on the very short-term relative strength indicator, we are oversold. So we hit the bottom of the channel. What did we do? We had a decent size bounce. Now, our what we like to see is both the 50-day Bollinger Band, or the 20-day Bollinger Band here, confirm the shorter term, the 2-day RSI for an extreme oversold condition. But meanwhile, marginally oversold on this here, even with that rally towards the close on Friday. So wouldn't be surprised to see a little bit more of a bounce, or at least the market stabilize at the lower end of this channel until it works itself off. Let's take a look at the spiders, SPY. And different story here. In the spiders, we're not nearly oversold. Look what happened. We tested the 200-day moving average. Now the 50-day, we're under it, so we are in a warning phase. So that is the overall scenario in the S&P. Clearly things are weakening, right? We're not all in bullish phases. The overall channel here in the S&P is sort of looking like this, and again forming somewhat of a down channel. We really do want this thing to, hold around this 200-day moving average. But meanwhile, we are holding that 200. We did bounce from it, although relatively meager. It's not like we had a massive up day, but we did manage to hold. So on Monday and this following week, we definitely want to look at the lows on Friday as a key support area. If we bust through there, we can definitely be in for some trouble, and certainly get down to the 202, 203, which would really coincide with the bottom of the channel. I mean, you can also take a look at that support area just as a horizontal level, which is pretty clear too. So decent size channel can be either support around that 203, 204, or if you're going to use the pure parallel that we had in here, let me put that in again, we're going to find support not that much lower, right? Just maybe 1% lower. So that's where I would look to find some level of support if in fact we do fail. So we got 204 and then right around that 202 level. So somewhere in there, but you're talking about a pretty decent size sell-off. That's 2-3%. That's pretty decent size. All right, well, what are the market internals telling us here about the market? Overall, you can see, let me get rid of that. Overall, you can see that we're at the midpoint in both the shorter term, the 10-day advanced decline line, and the up-down volume, both at the midpoint, including the McClellan oscillator. So that sort of coincides where we are right in the middle of this channel. Market breadth is not really indicating much of anything here. Let's take a look. I did want to take a look at QQEW and the Qs as well. So as you can see, this is the NASDAQ 100, but it's calculated a little bit differently. If you've been following these videos, this is an interesting chart because remember, the Qs, right, are the most powerful stock index across all countries right now. And there's a couple ways to look at it. If you look at it at the cap weighted, it's just QQQ. This one is equal weighted, so all the 100 stocks are equally weighted. It's a pretty good indication of breadth. And look at this. You can see that this week we broke down under the 50 and this yellow line here, which is the 100-day moving average. Now, we did manage to basically close unchanged, but nonetheless, you can see that the participation is pretty flat or muted in the NASDAQ 100. However, if you go to the cap weighted index, the more readily used, the QQQs, we're holding above the 50-day moving average. Therefore, with the 50 over the 200, we are in a bullish phase, and on Friday, nice recovery, closed above it. But as you can see, the breadth overall is weakening by looking at that QQEW. All right, let's take a look at some of the volatility indicators that we have. Sentiment, right? Just looking at VIX, we on the daily chart, this is the cash. We're basically, pretty much still at the lows, both on a daily basis, and if you look back, so over the last 6 months or so, we're holding steady right around that 12%. On an absolute level, you can see, if you go back to the weekly chart here, we were quite a bit higher. And yes, there is significant tracking error, so you're getting this huge deterioration. But nonetheless, we are trading still on an absolute basis at a really low end. So there's, even with this erosion of the breadth of the market and the lackluster sideways performance across the board, Dow is down a couple of percent on the year, with NASDAQ up and S&P sort of right there in the middle. So flat market movement in general. And with that and that sideways action, it's not surprising to see the volatility muted, but this is on an absolute basis. There's lots of complacency here in the market. These are low numbers. Looking at the spread ratio, which I think is a bit more predictive, the just looking at the absolute numbers is more of a coincidence, but it's good to look at the absolute numbers relative to the market action and make that comparison, and you can gather some useful information. But the 1 month versus 3 month ratio here is a little bit more predictive on an overbought, oversold basis. And right now, also in the middle of the range, attacked this moving average and bounced from it. Right now, I'm slightly I'm looking at this more as a negative on the market. We got a little bit frothy a couple days ago. We did get the sell-off. I wouldn't be surprised to see some more ultimately before we regain a true overbought reading again. I would be looking for it to potentially attack this lower area, which then would tell you that sentiment is running a little bit too bearish. Okay, so that gives you the overall scenario of the market. We are definitely sitting at an interesting area. The Dow looks like it's, has that confirmed down channel. S&P slightly, not quite as bad, with the Qs still leading the pack and led by fewer and fewer of the leading stocks. Amazon, Netflix, Google, Facebook. Those are some of your leading stocks. All right, so let's take a look at the interest rate scenario. Everyone's focused on that. A couple of interesting things to note. We're going to take a look at the yield curve here, or different types of bonds. First of all, we had pointed out that the longer-term trend in bonds was still intact. If we look at the weekly chart here, look at this. This green line here Look how it held it here. Again in here, that is the super long-term trend. It's the 200-week moving average. The faster moving average on the weekly chart, we like to use the 65. We're above both of those. So remember, we were talking a couple of weeks ago about how we were getting a bit oversold short term, but we were definitely under pressure on a longer term basis as we were under the 65 week, trading right on the 200, and it was a question mark as to how the market was going to react to the Fed raising. Well, this is pretty interesting action, and as you can see, we have traded nicely off that 200 week moving average, nicely above the 65 week as well. So longer term, can't argue with lower trend in rates. However, let's take a look at some other parts of the yield curve and different types of credit risk. Junk bonds, right? Not having a good time. They're not getting any benefit from the drop in rates on U.S. bonds. So that's an interesting divergence. Not a good sign. We want to see the junk and the more risky debt do better, and that would lend more credence to even more speculation or potentially higher prices in the U.S. Or the equities markets, but we're not getting that. Still under tremendous pressure in high yield. Now, a lot of this is related to the energy sector, so that might be distorting it a bit. Looking at high yield corporate bonds, almost exactly the same story. We also just recently went into a bearish weekly phase. Not good. So overall, different credit risk, the more speculative stuff not doing well. The 1 to 3 year U.S. Treasuries, and that you can see is doing almost as well as the 30-year or the 20-year bonds, and it is trading well above its 65-week moving average and also above its 200-week. So that longer term trend is intact as well. So quality bonds, U.S. Treasuries, definitely getting the lion's share of investor sentiment, and money is flowing in there. But as the Fed looks like it's going to raise rates, it's going to be interesting to see how the market reacts. Let's take a look at gold. Gold, very, very interest rate sensitive. So here you have a situation where you had this nice gap down. You do have an established down channel here. Believe it or not, what I'm seeing here as support, there's on the channel down, you're looking at about 90, another good 10 to 15% down from here if we can't hold this recent consolidation. And you can see wholesale liquidation. Now, one thing that is supportive to the market, and as you can see over the last week or so, 2 weeks, the market has stabilized as it's been oversold. So once it starts working off its oversold, it certainly can resume its leg down. Now, so we have two levels of support. One at exactly 100, right before the market broke out in 2009 for its huge leg up where it just about doubled in price. It broke out right around the 100 level, right? So 100 should be really good support. Worst case, you're talking probably down to that 88 to 90 level as well. So can we potentially mount a rally in here? Certainly. We definitely are oversold. Wouldn't be surprised to see that occur. All right, well, this pretty much wraps it up. I hope this was helpful. As you can see, the markets are definitely in a tenuous state. right? The Dow breaking down, NASDAQ looking quite a bit better, S&P somewhere in the middle, and not too much movement either way. However, sentiment, the the sentiment is definitely favoring a little bit to the overly optimistic side, and that could play out. And you need a flush here to get sentiment back to a more normal trading level. And again, the other point is the breadth in the leading index. The Q's definitely weakening. All right, have a great week. Enjoy the summer, and speak to you next week. Thanks, and bye for now.